Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates and 10-year note yields, a sharp move lower one day after the Fed raises rates 25 basis points. We saw the move back towards 280. We didn't get through it, and even more significantly, we didn't get through 275, which is the key level to the downside in yields, which if we break out of could start a real short squeeze, given the fact that we've got so many massive short positions from the spec market out there. And I think right now we're still in that range, but we did test 280. We kind of got to, we're holding around 284 right now. A lot of news flying around, whether it's about trade, whether it's about tariffs, whether it's about the politics in Washington, whether it's about the Fed yesterday. There's a lot of reasons why the market could be moving, but a delayed move pushing bonds price higher, yields lower, along with stocks getting hammered, it really has the market kind of twisting and turning here. And if you look at implied volatility in the Treasury market, it was up today, but only modestly and not in line with what I would consider what the macro sell-off, the macro market that we saw. Gold higher, stocks getting crushed, yields modestly lower, and Treasury volatility just kind of ho-hum. So I think right now the market may be mispricing something. If we do see a trade below 280, I do expect that volatility to really ramp up. Likewise, we need to get all the way, I think, north of 290 and close to 3% before we start to see volatility go higher. If we do see bonds trade back lower. And lastly, let's talk about what is all the cause of this move in the market. You have the Fed versus the politics. The Fed outlined its gradual policy of moving rates higher in 2018 and bumped up their expectations for maybe modestly quicker rate hikes in 2019 and 2020. But let's take a look back at what happened in 2015 and 16 with the Fed. They did the same thing, and really they talked about looking at the data and raising rates based on what they saw and hoping to have higher rates, and they only raised rates once in each of those years. So I think that right now the fact that we're looking at possibly higher rates in 2019, 2020 really is irrelevant. I think the market needs to look at what we have right now, and that's 3 rate hikes in this year. Possibly, if inflation comes off or if GDP growth continues to have lower expectations, or if the economy sputters, there's going to be a lot of questions asked, and that could lower the Fed's expectations. One of the reasons why I think the market is reacting the way it is. And if you look at the politics side, we don't really know what's going to happen with the trade and the tariffs. Yes, the president has implemented his $50 or $60 million tariffs on China, and that could have some retributions. But right now, the stock market is fearful that there could be more behind it, or at least there could be more ramifications. Hence, you're seeing the massive sell-off there. But we're not seeing that overreaction in the bond market yet. I think the bond market is keeping one eye on what's happening in trade, but also one eye that's happening with the economy and the Fed, and how closely those two are interrelated, we have yet to see. So right now, heading into Friday's trade, I do expect we'll see a normalization heading into the weekend, with yields holding between that 280, 290, and stocks maybe seeing a little bit of a bounce back higher after today's big sell-off. This is Todd Colvin coming to you from the floor of the CME Group.